and thank you for the opportunity to present to you today. The topic of my presentation is Hedge Fund 101, and what we really want to do today is run you through the hedge fund asset class, how it's different from the long-only asset class that all of you are used to, and why we think it's a fantastic tool to use in the current environment to build the best portfolios for your clients. So I'm Jacques Conradi, Managing Director of Bi-Directional Capital. We're South Africa's longest running hedge fund and one of the most successful hedge funds in the country. I think hedge funds are particularly topical right now. If we look at the last 3 or 6 months, we've seen a massive increase in IFA and retail client interest, and I think it's given the tough SA economic environment and the volatile markets, I think hedge funds have really shown the value they can add to a client portfolio. We think hedge funds are going to be a much bigger portion of overall client allocations 2 to 3 years from now, and hopefully this presentation helps to explain why that's the case. So a little bit of background around our firm. We were started 22 years ago. We're a boutique asset manager, and we manage a bit more than 7 billion rand in client assets at the moment. We've had the same investment process and philosophy all the way since inception. Naturally, what we do is we keep trying to get better. So we keep evolving our process, we keep applying learnings from mistakes we make and from things that go well to the process to keep improving it, but there's been a consistent philosophy all the way through. And then I think for those of you that's less familiar with the overall hedge fund sector, we are one of the most successful funds in the country. If you look at the Hedge News Africa Awards, which is the large SA Industry Hedge Funds Awards, they've had a medium-term performance award, which is a 5-year performance category for the last 8 years now at this award ceremony. And Bi-Directional Capital has won this award at 6 out of the last 8 years. So let's get on to the key features of a hedge fund. Firstly, there's many features that's similar between both a hedge fund and a normal unit trust or a long-only fund that's very commonly utilized. So firstly, both are regulated collective investment schemes. Over the past 5 years, the regulation has been unified. We fall under the same regulatory umbrella as normal unit trusts, and you've got the same regulatory protections and limits on the fund to protect investors. We run multi-asset portfolios, so where equities are our major asset class, we do utilize bonds and other asset classes to optimize the risk and return in our funds. So this will be very similar to the multi-asset long-only funds that you're used to. We also have various risk profile funds. We've got low risk, medium and high risk funds to cater for different investors with different risk return demands. However, where things start getting different is the fact that we've got bi-directional investment strategies. That means we can own companies we like, but we can do something long-only can't. We can bet against companies that we don't like or that we think will underperform. That's called shorting, and it allows us to take advantage of negative views on companies. This then fits into the next point quite closely. We're able to much better protect investors' wealth during periods of down markets. Because of shorting, because of overall portfolio hedging, we've got access to in our toolkit that the long-onlys don't. We can deliver better outcomes in those environments, and I think that's been very, very clearly shown so far this year. If you want to know why hedge funds have been less well-known and less used in the recent past and why we think that's about to change, I think this slide covers that very well. So firstly, as I said, 5 years ago, we weren't under the same regulatory framework as the long-only investments. We are now. That's been unified. The funds used to have quite high investment minimums. That was a R1 million minimum investment, which excluded many investors from putting a portion of their portfolio into our funds. That's now been reduced to 25,000 Rand for direct investments and effectively no minimum investment when utilized on the major platforms. Our funds have also moved from monthly dealing to daily dealing to unify with a long-only space and make it easy for you and your clients to switch into and out of our funds as you would do for the other funds you are used to. We're open to all retail investors with no minimums, and a big change for us has been getting LISP access available to IFAs. So we know this is a preferred allocation methodology. It really simplifies things from the IFA's perspective. So currently we're listed on both Momentum and Allan Gray. Both our flagship funds are on them, with several of the smaller platforms also having access, and hopefully we'll be on all the major platforms within the next 3 to 6 months. So let's now talk about the hedge fund toolkit that I've discussed, and that I think is the key reason for the different risk-return outcomes we can deliver for our clients versus long-only funds. If we start on the right of this slide with unit trusts, you can see that the typical long-only manager is really limited to a buy and hold investment strategy. They can buy shares they like, or they can avoid shares they don't like, but that's really where the story ends. And thus they end up being very dependent on a rising overall market to generate return for their clients. Over the last 3 or 5 years, with a very muted JSE overall return environment, we could really see the very significant negative impact that had on equity funds and multi-asset funds in SA, with very few standout performers in the long-only space. Moving on to the hedge fund side of things, we've got much more flexible investment strategies. I touched on the shorting example earlier that allows us to make money in a very tough economy or a falling market by betting against SA companies that's struggling or losing market share or got financial difficulties. And pair trading is another great strategy we have access to, where we can pick the winners in a certain sector, and against that we can short or bet against the losers in that sector, which allows us to generate alpha or outperformance without taking much overall market or beta risk. This then feeds into, again, the point about our additional ways to protect in market downsides. We aggressively use put options to protect against overall market declines, and we are also fond of using assets with negative or low correlation to equities, adding them in our mix to generate more consistent outperformance that's much smoother through the upswings and downswings we see in markets. It allows us to thus generate these very consistent long-term returns, and I think maybe one more key point to touch on is the fact that we are not benchmark cognizant. We really don't care about the size of a share in a benchmark. Our only goal is building the best possible portfolio for our clients. That means finding great companies that will in their own right deliver great returns for investors, but we then also decide how we're going to mix and blend them together to give you the best portfolio with great expected returns, but also minimize volatility and drawdowns in periods of market difficulty. So completely ignoring the index weightings and just finding the best shares to add to that portfolio. Let's look at a few examples of hedge fund strategies that you won't be typically seeing in long-only portfolios. So first off, we will start with a straight short sell or a bet against a company. The example here is a business called Nampak. It's South Africa's biggest packaging company. About 3 years ago, we identified real issues in this business. We saw competition increasing in South Africa, where there was competition starting up in the beverage can side and on the paper manufacturing side. And that, together with the fact that this business had overexpanded into Africa at too aggressive a pace, led them with some real issues. So they bought a big beverage can line in Nigeria at way too high a price, and they actually spent a lot of money building a beverage can facility in Angola. When conditions in Africa turned and US dollars dried up due to the lower oil price, they were stuck with these two assets. They couldn't get enough aluminium inside to make the beverage cans, and then they couldn't get access to dollars to take their profits out. So a combination of that, the difficult SA competitive environment, and then way too much debt on their balance sheet led to massive pressure on this business. We shorted the share at 20 Rand, and we bought back our short at 6 Rand. That's a 14 Rand profit, which is about 70% profit on the short side. If you're a long only, the best thing you could have done is not own this and not lost any money. Many long onlys did own this and lost the money. Those that didn't made nothing. Whereas a hedge fund, if you correctly bet against this business, you could make 70% return in a very difficult SA market to offset the difficulties that other companies you might have owned would have faced during that period of time. Let's now move on to a typical pair trading idea. As I touched on earlier, a pair trade is when you own a share in a sector and you bet against another share that you believe will underperform that share in the same sector. So in this example, the shares are Capitec, which we owned, and Absa that we went short. So the opportunity to buy Capitec was created for us by the Viceroy short selling report written on Capitec early in 2018. We've known Capitec for a very long time. We've covered the share since about 2007, know the business well, and we could very, very easily see that most of the facts in the short report were just misrepresentations or exaggerations, and there was nothing new here that would be negative for Capitec. Yet the share fell 30% on the 2 days when the report was released. I think this basically has to show you that the average fund manager or analyst covering the share didn't have the comfort with their investment view that they could easily debunk the short report. They instead worried about whether they had the call right or wrong and whether they had done their research properly. We were confident enough to buy the share at that time, saying the report's nonsense, things will go back to normal. However, at the time, we were also fairly nervous about the overall prospects for the SA market. So rather than just outright own Capitec, we said, let's also short Absa against that. What does that do? It takes out the market risk from this trade. So if the overall market goes up 10% or down 10%, you've got the long position and the short position where the market move is taken out, and the profit we make on the trade will be the outperformance of Capitec versus Absa. So you make the relative performance. We also like the trade because Capitec was gaining a massive amount of clients. They were gaining more than 100,000 new clients a month, and many of those clients were coming from Absa. So you were betting on the market share gain winner, and you were going short the market share loser that was also unplugging their IT systems from their parent Barclays at that time, leading to a distracted management team. My next example is then how we manage the overall portfolio. So over and above a portfolio of great individual shares that we think will do well in their own right, we also have the portfolio management hat on of saying, how do we blend this together and how do we hedge the overall portfolio to deliver the optimal risk-reward outcome for our clients? As a business, we love exponential curves. Exponential growth curves is often how you make great investments where you make 2, 3, or 4 times money for clients. A great example of this is, again, Capitec that I touched on in the previous slide. We own that all the way from 150 Rand to 800 Rand a share as they massively grew their client base. I think Naspers and Tencent is a further great example where Tencent has compounded at a very attractive rate for a very long period of time, leading to long-term investors making much more than 10 times their money over the medium term. So we love exponential curves. However, exponential curves can also work against you. So early on in January, when COVID was spreading in Wuhan at the time, we could easily see that there was an exponential curve embedded here, and that if this virus got out of China, there could be a massive global issue. So we effectively at that time got our whole team to do research on this, to do all the reading we can, to closely monitor the case numbers. And the key point we were looking for was whether COVID was going to be contained in China or whether it was going to spread around the entire world. The key signal for us was the weekend at the end of Feb. It was the Friday, the 21st of Feb. On that Friday, Italy had only 3 COVID cases. By the Sunday afternoon, they announced that they had 200 COVID cases. This might seem like a small absolute increase, but it's a 60-fold increase in cases in only 2 days. And this was a very clear indication for us that COVID would now not be contained and we were dealing with a global pandemic here. Our team was busy discussing this that whole Sunday, and we agreed to come in very early Monday morning to have a 2-hour team huddle and figure out how we're going to protect the portfolio during this crisis. We knew that as other informed investors, especially US investors, woke up on the Monday, they would likely, or the informed investors would likely come to a similar conclusion. So we acted aggressively and fast, and we decided to buy put option protection on about half our entire portfolio. Now, with the benefit of hindsight, this might seem like an obvious trade. However, very few investors did it at the time, and it wasn't that clear with only a few hundred cases outside of China that we were facing a global pandemic. But knowing how exponential growth curves work, we saw that risk very clearly. And additionally, you had the benefit of the market still being at all-time highs and volatility being extremely low. I equate this with an example of you're staying in a house and both houses next to you are currently on fire. You don't have fire insurance for your house and you phone your insurance company. Somehow they still sell you the fire insurance at the normal price, despite the fact that the houses next to you are burning. This is really the case we had here. We could buy insurance on our funds with this massive pandemic risk out there while markets were at their all-time highs and vols were extremely low. I think the benefit of us acting aggressively and early was made very clear when I think even later that same day, these options were 2 or 3 times the price. So you really had to think fast and move aggressively to get that protection in. This obviously then served us very, very well during the sell-off in Feb and March, and it put us on the front foot where we could react positively, engage with the market, and accumulate shares that we like into the market sell-off. With things having progressed now and governments having massively stimulated their economies together with a reduced interest rate environment, markets have since then bounced back, and we're fairly close to all-time highs or might have just breached all-time highs in some markets. So what's the best way to protect your portfolio right now? We think gold is a fantastic tool to add to your portfolio. I think very few investors do own gold at this stage, and it's not been a particularly popular asset class over the last 20 or 30 years. I can understand that in an environment where you're getting 3, 4, 5% interest rates on your money in the developed world. However, we're currently dealing with an environment globally where for the first time in recorded history, we have all developed market interest rates at 0 at the same point in time. Dollars, pounds, euros, and yen all pay you 0. So basically, if you're an investor sitting on excess cash, you are being punished. Governments are punishing you to bail out companies and individuals with too much debt. You are guaranteed to lose money in real terms on your cash over the next 3 or 5 years. So basically, that's the perfect type of environment to say, why do I own cash? They're printing more cash, they're devaluing this. Shouldn't I have a material portion of my cash in gold? So we think more and more investors will come to that conclusion. And then I think that one further benefit over and above the lower rates is the geopolitical risk that the world will face over the next 10 or 20 years. All of us have gotten very used to a fairly peaceful global environment over the last 30 years with the US, the clear global power that kind of ran the global economy. However, for the next 10 or 20 years, we're going to have China and the US fighting it out for who the global dominance belongs to. Those are tricky times with lots of events that's very hard to predict. We've already seen this in the last month with the US banning the Chinese tech companies from their market within a very short period of time. So gold provides you protection against low interest rates and the geopolitical risk that's out there. And it's also an asset that's typically negatively correlated with overall equity markets. So it's a great asset to add to your portfolio to protect you in market down and market down cycles. So let's move on to the benefit of hedge funds and specifically our funds to investors' overall portfolio. What we've done on this slide is we've looked at our two flagship funds, the Pure Hedge Fund and the High Growth Fund, and we've compared them with every other fund in the SA market over that period of time. We said, let's assume that an IFA had perfect foresight. On the day that our funds were launched, let's assume out of the more than 2,000 unit trusts around, they picked the very, very best one for their clients at that inception date. How would that advisor have done for his clients versus investing in our funds? Luckily, the outcome for us is fairly pleasing on this. If I start with the graph on the right in the Pure Hedge Fund, since July 1998, R1 million invested in Pure Hedge is up 6,000%. That means R1 million day one is worth 61 million rand now. Had you picked the very best fund in the country that's not ours, that R1 million would have been 26 million rand. That's still a good outcome, but Pure Hedge did more than 2 times better. And then that comes with the added benefit of never having a single down year in that entire period for Pure Hedge. So it gave investors a great return and also a very, very smooth ride without the stress of having big down years. If we look at the left-hand graph, our High Growth Fund has done even better during that time. The fund launched on 1 Feb 2000, and R1 million there on day one is worth 95 million rand now. Had you picked the very best fund out of the other 2,000 funds available, you would have been left with 20 million rand. Still a great outcome, but High Growth did almost 5 times as well for investors, again, while taking lower volatility than the other funds. So these outcomes were not achieved by taking more risk. They were achieved by great stock selection, great company analysis, and then overall portfolio management skills to manage the return and the risk of the overall portfolio for investors during that time. This is the standard risk or return graph that kind of all of you will be used to, and basically it's used to pick funds based on an investor's risk profile. So on this, we just want to show you where our funds sit. The Pure Hedge Fund has a very similar equity exposure and volatility to the typical stable fund category, and the High Growth Fund has a similar volatility and risk profile to the balanced fund category. However, both funds have done substantially better over the last 15 years. You'll see Pure Hedge is about 5% per annum better than stable funds, and High Growth is about 11% per annum better than the balanced fund category. Both funds are substantially lower risk than a typical equity fund. Given the volatility we've had in this year, I think it's very important to talk you through how we protect investors' money during down cycles, and to also then after this look at how we performed this year. So as I touched on earlier, Pure Hedge over the 22 years has never had a negative year. In fact, the biggest ever peak to trough drop over 1 month, over any period was only 5%. So that's from any point that investor invested, he never lost more than 5% before we made it back. That's a very smooth ride, and typically we've got very, very happy investors in this fund, handsomely outperforming cash and inflation while not having to worry about the downside. You'll see 88% of the months in this fund has been positive over time, which means typically you only have about 1 negative month a year in Pure Hedge. For High Growth, the outcome's also been good. 18 out of the 20 years the fund's run has been positive. The biggest drawdown, though, is bigger. In this fund, we take more equity exposure to have the option of generating higher returns, but that does mean that the fund is somewhat more exposed to equity markets. It's still done much better in down years, though, as you'll see by the 17% drawdown versus the 40% peak drawdown that we've seen for the JSE capped SWIX. Let's now move on to look at how we've managed the funds during the year to date, which has pretty much been the most difficult investment environment since at least 2008. During Jan and Feb, The SA economy was already very weak, so the SA market was down over that time, and then obviously this accelerated during Feb and March as COVID spread throughout the world and as people started to realize that. You'll see that Pure Hedge actually had a fantastic first quarter. Despite the massive market decline of almost 30% during that time, Pure Hedge was actually up for the quarter and only had a very small down month in Feb. For high growth, the story was slightly different. During Feb, when we realized the impact that COVID would have on the world, we re-looked at the portfolio and we realized that the outlook for many of the South African stocks we owned was very, very poor. SA was going into this with an injury anyway, and COVID was likely to push us over the edge. We would further have to gear up the government balance sheet, and SA companies that were already on their knees would have to face another crisis at a time when things are already difficult. So we aggressively traded out of many of our SA exposures and decided to switch those into offshore and US exposures where companies would not be impacted by COVID or potentially be beneficiaries, and where we could build a much more diversified return stream for investors. So currently our portfolio consists of some great growth businesses in the US, but we've also got exposures in Europe, in the UK, and in Asia and China. We feel that at this point in time, a very well-diversified global portfolio is the best case outcome for clients. You don't have to worry about the currency. Most of the currency of our offshore positions we've hedged back to Rand. We realize we run Rand funds where investors don't want to take the Rand dollar volatility fully. So on many of those positions we've hedged it back, but at least it allows investors to gain great returns without those returns being correlated only to the SA economy or the SA markets. So that's the pain we took in Feb when growth was down about 5% as we aggressively repositioned the portfolio. But you can see then on the graph that this handsomely paid off. Where in March, the fund was only down very slightly when the market was down more than 15%. Pleasingly, we also then kept track with markets. As things bounced back, our funds caught a lot of the upside, and we were sitting at the end of July. Both funds are up just below 10%, with the capped SWIX still down about 6 or 7% for the year. So I think a great outcome for investors, especially during Feb and March, where they faced a much smaller drawdown than they did in most other funds. So correlation is a very important measurement criteria for portfolios. What we want to create with both the Pure Hedge and the high growth funds is we want to have portfolios that's going to generate great returns for clients. But we also want that funds to have another key feature. We want them to have the feature that if you add them to your overall portfolio, they're both going to increase the expected returns, but also improve diversification and reduce the volatility of your funds. So that's really the best of both worlds. You get increased returns in your portfolio by adding our funds, but also reduced volatility and reduced drawdowns. I think this graph very clearly illustrates that. We've got the 5 biggest unit trusts in SA listed here, and it's clear that their correlations are all very high, between 85 and 95% correlated to the overall market. So while investors might think they're diversified by owning multiple fund managers, they're really just taking the same bet on the overall SA market. You can see also on this graph that high growth is only 65% correlated, with Pure Hedge correlated only about 35%. So you're getting much more diversified return streams in those two funds. And the pleasing thing is with the way we've built these funds right now, current correlations are even lower. Pure Hedge year to date sits only at about 50%, Pure Hedge sits only at about 10 or 15%, with high growth at about 50%. So both of these correlations have even been lower during this very difficult time. Let's now spend the last while of the presentation looking at our two funds and what we're trying to achieve with them. So if we start with high growth, this fund tries to optimize the growth of investors' money over the medium to long run. So what we're going to do here is own our very best ideas in fairly sizable positions across the fund to maximize long-term returns for clients. We want to still manage the risk of the fund, and thus we still apply our overall portfolio management and risk management skill set to this fund to ensure the volatility is substantially less than a typical equity fund, and it behaves more like a balanced fund while delivering these market-leading long-term returns. Let's look at how this is played out over various time periods. I think the pleasing thing here for us is that the strategy has really paid off over all the time periods you can mention. Year to date, 1 year, 3 years, 5 years, 10 years, 15 years since inception. A very, very consistent picture. You can see the blue bars being the high growth funds returns versus the multi-asset category being the red bar and the overall market being the gray bar here. The outperformance over all the time periods has been above 5% per annum, and it's been surprisingly consistent on all the measurement periods, which is a very pleasing outcome and really what we want to achieve here. I would point out that on the 5-year numbers, the returns are quite a bit lower than what we actually target and what we typically have achieved for this fund longer term. That's just an impact of the very, very tough SA market and economic environment. 5 years ago, we realized that the SA outlook was worse than before, and we started spending a lot of our team time finding great offshore investments that we can add to our portfolio over the medium term. However, with the benefit of hindsight, we could have moved sooner. So from the start of this year, when SA really started suffering and when it became very clear to us that the South African issues was going to be around for the medium term and not going to go away quickly, we switched an additional part of the portfolio into offshore markets to the extent that we've got very, very low exposure to domestic SA right now. However, we didn't think things were going to be this bad when we sat 3 or 5 years ago. So with the benefit of hindsight, we could have done that sooner. However, the relative performance has still been fantastic versus other funds over that period of time. And pleasingly, where we sit right now, our portfolio is the best position it's been for a long period of time. As I mentioned earlier, we've got a fantastic portfolio of independent, well-diversified, uncorrelated return streams in the portfolio that's highly likely to deliver great outcomes for clients over the next 3 to 5 years while being uncorrelated to their overall SA market. Let's now discuss Pure Hedge. In this fund, we really want to help investors grow their purchasing power. So we want to beat cash or inflation type returns by about 5% per annum while managing the downside very carefully. Investors in this fund don't have a lot of risk appetite, and we know that. That's how we manage the funds. We want to reduce drawdowns, but still generate that growth and purchasing power for you. So we'll have many of the same positions that we have in high growth will also be in Pure Hedge, but we'll adjust the position sizing and we'll more actively use shorts and overall hedging to reduce the volatility in that fund. As I said, over 22 years, the fund has never had a negative year. If we look at the return picture for Pure Hedge, it's been very pleasing and even more consistent than high growth. If you look at all the time periods here, again, 1 year, 3 years, 5 years, 10 years, we've very consistently outperformed the SA multi-asset low equity or stable fund category and handsomely beaten inflation. In fact, the 1, 3, and 5 year numbers are very consistent at around low double digits, which is really what we aim for in this fund in various market environments. So, and I mean, these returns have been achieved with a very, very weak market tailwind. In fact, there's been a market headwind during this time, and there's been ups and downs, yet Pure Hedge, because of the way we create the fund, has been consistently able to deliver that outperformance while limiting the drawdowns. So that covers our 2 flagship funds. Thank you very much for your time today and for listening to the whole presentation. I hope this really showed you the value that hedge funds can add to a client portfolio by both reducing risk and enhancing returns, and why we're believers that hedge funds will be much more actively utilized in the SA asset management industry, and especially by IFAs over the next 2 or 3 years, with the improved access on platforms and with, I think, the clear proven track record of achieving great investor outcomes. So if you'd like to hear more or speak to us individually, please reach out and contact us and contact Alan Yates or Dudley Lamont Smith. And thank you very much again for the time you spent with us today.